Okay, so here we come the concept of options. In fact, practically in derivative segment, 90% of the volume takes place in options, only 10% in futures. And various strategies, hedging, various kinds of permutations, combinations is possible in options. Such a beautiful concept, risky concept as well. Whatever may be the view you can take in stock market, you have a option strategy available. You see, in the future only two views was possible. You have a bullish view expecting the market price to go up. You should take a long position. You should do future buy. You are expecting the market price to come down. You should take a bear position. You should short, future sell. That's all. Price going up, price coming down. Only two views possible. In the options, you have multiple views possible. For every view, you have a strategy. My expectation will go above this price. You have a strategy. My expectation, share price will not go above this price. We have a strategy. Share price will be falling between these two prices. You have a strategy. Share price will go beyond this price. We have a strategy. It's just amazing the way option strategies can be built in options. But you don't have to learn all those strategies. Here and there we'll give a jalak of it, but in detail we are not required to know it. But you have to understand the very basics in options, what are the terminologies involved, and how the operations and settlement will take place. So now this session will try to do an overview, kind of summary of entire options, and then we can take up the practical aspects. Okay, so what is a definition? I'm sure you might have in your material as well. First, let me tell you the definition, basic definition, so that we'll get the foundation. Then I'll go for the individual terms along with the uh, terminologies. A financial derivative sold by one party to another party. Any transactions needs a buyer, needs a seller. But in the option, you are called as option seller, you are called as option writer. And option buyer is called as option holder. The contract offers the right, but not the obligation to buy an underlying asset called as call option, to sell an underlying asset called as put option, an underlying asset, maybe shares, maybe index, maybe commodities, maybe even foreign currency, maybe even interest rates at an agreed upon price called as strike price during a certain period of time called as expiry date or expiry period for a consideration called as option premium. Okay, now let me give you the basic understanding of this. Then I'll go you. Then I'll go one term in detail. Okay. First, take a look at this. In spot market, it is immediate settlement. In forward market or in future market, it is agreement to buy at a certain price. Other party will be agreement to sell at a certain price. Please pay attention here. In options market, it is agreement not to buy, agreement to have a right to buy at an expiry date. So option contracts are very much like insurance contracts. The purpose of option, the introduction of option is actually to protect the risk. Now it is being taking place in different forms. Okay, anyway, let me give you the basic idea. Then I'll go in by details. Okay, now two things you have to understand. One is option instrument. One is option instrument. That means rights. Option instrument having a right, like insurance policy, having a right, and the other is about underlying assets. Underlying asset. Now, option instrument will have a consideration that is called as option premium. Option instrument will have a consideration, option premium, and underlying asset will have the consideration for that is called as strike price. Now, option premium is the amount paid by the buyer. Buyer is called as option holder. Option holder will make a payment to the seller. Seller is called as option writer. So option holder will pay the premium, just like insurance policy holder pay premium, and writer receive the premium. Basically, he assumes obligation. Writer assumes obligation. Now, what right you purchase? You pay premium, you get the rights. Holder gets the rights, gets the option. Holder gets the right. Writer assumes obligation. What is obligation? What right you get? Listen to me carefully. Holder, I make a payment of premium to the writer and I get the rights. And what right I get? The right to buy the underlying assets at strike price. So you get the right to buy the underlying asset at strike price. And when do you make a payment? Not today, on expiry. I'll explain all this stuff practically, don't worry. Today, this is on expiry. Holder makes a payment called as option premium. And you get a right to what? Right to buy underlying asset. This is called as call option. When you get a right to buy, this is called as call option. This is called as call option. And when you have a right to buy, what will another person will have? The writer will have to sell. If you have the right, somebody will have the obligation. The writer will have obligation to sell the underlying asset. At what price? At strike price. When? On expiry. Just like you have the right to buy, you can also do right to sell. That should be decided earlier itself. So if you have right to sell underlying assets at strike price, right to sell UA means don't think some rating a movie rating UA means underlying asset. Right to sell underlying asset at a strike price on expiry, that is called as a put option. Put option holder, you have the right to sell. I'll summarize, don't worry. And if you have the right to sell, other person will have obligation to buy the underlying asset. Obligation to buy the underlying asset. So typically you have to understand there are four legs. Holder, call option writer. Put option holder, put option writer at a different strike price. For different, each strike price is different contracts. Please take down this. I'll show you practically some data. Hope you can understand the numericals better. And then I will do the summary again. Hope you can understand. Then I'll go for some more terminologies. First of all, any doubts in this basics? What are the terms you understood here? What is option premium? Who is holder? Who is writer? Call option, put option, expiry, strike price. You enter into an agreement today, you buy the option instrument today. How do you buy? By paying option premium. What right you get? I can buy the underlying asset or I can sell the underlying asset. When will you do it? On expiry. If you have the right to buy, it's called as call option. If you have right to sell, it's called as put option. So for buying, we use call option. For selling, we use put option. Other person, that is writer, will have the obligation and he receives the premium. Everybody is compensated. You pay the premium, you get the right. Other person receive the premium and he will have the obligation. So one benefit, one cost. Basic structure of call option, put option. Any question you ask? I'll go to the practical data after this. Okay, hope you have taken down. I'll go to the website now. I'll show you the practical stuff. Hopefully, you can understand better there. So I'll go to NSC India website. Hope you're able to see. So let's look at Reliance Industries. What is spot price? Can you see? 2413, 2413. This is called as spot price. And you also know how to look at the future price. Let's not look at future price. Let's look at the options. We have derivatives. And I'm looking at options. So I'll select options. Stock options. Okay. Expiry date. You know I can select 3 expiry dates. 30th of December, 27th Jan, 24th Feb. Why is that? Hope you understand. Remember, we have discussed in the futures. In India, we follow current month, next month, subsequent month for option, stock option. For index, we have more also. Basically, 3 expiry dates at any point in time. Let's look at December 31st, December 30th. Option type. Two types of option is there. You should decide in advance. You want call option, you want put option. Let's say I'll select call option. Look at this. We have different strike price. I'll select one strike price. Let me tell you what is the interpretation of that. Let's say 2413, 2300. Okay. 2500. Okay, 2500. Close the price, 39.65. Let's say 40 rupees, rounding it off. Hope you're able to see the all the data. Let me explain you. See if you're able to understand this. You have call option at 2500 expiring on 30th of December and it is going to cost you premium of 40 rupees. So today If you pay 40 rupees, you are buying call option. You pay 40 rupees and what is your intention? What is your expectation? That on expiry, I will be able to pay 40 rupees. I will be able to pay 40 rupees and get the share at 2500 rupees. I repeat once more. We are today, 5th of December, let's say 6th of December. Expiry date, 30th of December. If I pay 40 rupees today, I will get the rights today. I cannot exercise today. I will get the rights today. When I can exercise? I can exercise on expiry date on 30th of December. I will pay 2500 rupees and get one share. Now, can you tell me what is my total cost in this process has become? Today, I pay 40 rupees and on expiry, if I want, then I have to pay 2500. You treat like this in token advance or something. So I pay 40 rupees today and I pay 2500 rupees on expiry date and I get one share. So can you tell me what will be my cost of one share? Okay, maybe very difficult for you to calculate. You need calculate help maybe. I'll tell you. You are paying 40 rupees today and you are paying 2500 on expiry. Your total cost is 2540. Very difficult to calculate, I understand. So I'm telling you. Hope you got the basics. I'll do a quick summary chart and all. But try to think, have you got the basics of call options? On the expiry date, I can buy the share at 2500 irrespective of market price. Because today only I paid 40 rupees. So on expiry, I will pay 2500 and today I paid 40. 40 rupees for the right. 2400 is for the instrument. Total cost is sum of these two for me actually. Okay, now imagine on the market on the 30th of December, if the market price is 2600, if the market price is 2600, now which is better option? You go to market and buy or use this option, use this right and buy it. You go to market, it is available at 2500, 2600. In this option, available at 2500. So it's cheaper to buy in the options. But imagine in the market, if it is 2400 rupees, in the market, if it is 2400 rupees, then in the market, it is 2400. In the options, it is 2500. Are you having an obligation to buy this 2500? No, you have the rights. So what do? You don't use the right. Whatever options you paid, you forget, that is gone. But in the market, you can buy at a cheaper price, 2500. 400 in the market, but in the option you have to pay 2500. Don't use the option. It's an option, it's a choice, it's a discretion. You don't have an obligation. Don't exercise. Whatever amount paid lost, it's okay. But I can go to market and buy it. So when this option becomes beneficial to you, if the market is rising, if the market rises, then this option will be useful for you because your purchase price is fixed. In call option, your purchase price is fixed. Market price can go to 3000 rupees at the end of the month. I don't know. But for me, my purchase price is 2500 plus whatever amount I already paid, 40 rupee is my total cost. Okay, so can I say like this then? When the market price is high, call option is beneficial. When the market price increase, call option is beneficial. We can also analyze like this. Suppose at the end of the month, let's say I purchase this option. I purchase the option. At the end of the month, it becomes 2600. It becomes 2600. Now, what do I do? Will I use this option to buy? Yes, available only at 2500. I will use this option to buy at 2500. and I go to market. Market, what is the price? 2600. Are you understanding the opportunity here? By using my option on expiry date at 2500, and tomorrow go to the market. I mean, not tomorrow, on expiry, go to the market at 2600, 100 rupees my profit. Buy at 2500, sell at 2600. That is called as intrinsic value. Intrinsic value is the difference between market price and strike price. But I already paid 40 rupees profit expense. I get 100 rupee profit, but I already paid 40. 60 rupees my net profit. Net profit is called as payoff. Net profit is called as payoff after adjusting premium. Now, this is the position today. Now tomorrow, uh, if the market price increase, if the market price increase, you know what will happen to this premium? This premium also will increase. See, in futures, future price is traded every day, right? In options, option premium is traded, the strike price is fixed. See, for 2500, you will pay 40 rupees. If you want 2600, if you want to have a bet that will be 2600, you have to pay only 29 rupees or 17 rupees. Because, when purchase price increases, the profitability comes down. But anyway, what you have to understand is, for a different strike price, the premium will be different. Let me do a little bit summary, but before that, if you have any question, get it clarified. I'm showing practically only. Correct. Lot size will always be there, but don't worry about the lot size for time being. Just imagine one share for discussion purpose. Does not matter, because again here also I can discuss in two ways: settlement by net basis, settlement by delivery basis. If I tell you settlement by delivery basis, which is what I explained, you paid 39 rupees. Already you paid now itself. Premium paid, you already paid. On expiry date, you pay 2500 rupees more, you get one share. What is the premium at that point in time does not matter. If you settle by delivery basis. Hope that transaction is very clear. On expiry, you make a payment of 39 already paid. You make a payment of 2500 and get the share of Reliance. One share come to your account. Just like in future, settlement by delivery basis, you would have already agreed upon a price. On expiry, you make that payment and get the share. Settlement by delivery basis, theoretically. But practically, most of them, we don't do settlement by delivery. It's possible, it's allowed in exchanges, but most people don't want to do that. We go by net basis. I'll explain you what will happen if you go by net basis. Okay. Now, if I ask you this question, see if you can answer. Suppose market price is 2400. Suppose if the market price 2400, do you think this option you will exercise? You are a holder. You paid 40 rupees. You have the right to buy at 2500. You already paid 39 rupees. Now, if the market price on expiry is 2400, will you use this option? You have a choice. Will you use this or you let it go? You don't use this. You will not use, right? Why will you buy 2500 unnecessarily in the market available at cheaper rate? In that case, we say option lapse. Option lapse. Whatever you paid, gone. That premium, gone case. That's the problem with options. You can multiply your profit or losses, but your capital can be evaporated so easily. Okay, now this 2,500, suppose on market, on expiry, market price becomes 2,600. Now, this contract will definitely be exercised because cheaper price. What is the differential amount? 2,600 is the market price. 2,500 is the strike price. So, benefit is 100 rupees, right? The benefit of this contract is 100 rupees. On expiry, that will be the intrinsic value. On expiry, I'm telling. On 30th of December, the value of option premium will be equal to intrinsic value. On expiry, on 30th of December, if the market price closes at 2,600, this strike price 2,500, so this option will be worth 100 rupees. Option premium will be 100 rupees. You paid already 60 rupees or 40 rupees. Now you close your position at 100 rupees, you get a profit of 60 rupees. This is settlement on net basis. What if I want to settle below before expiry? That is uncertainty. I don't know what profit or loss I get. Tomorrow, if the market price goes up, this premium will change. At a different premium, I should close my position. If it might be at a profit, it might be at a loss. But if you want to settle by delivery basis, you have to wait till the end expiry. We have two kind of option: American option and the European option. But we follow European option. European means you have to wait till expiry. American means you can exit anytime before expiry. But that is not there practically for solving problem also. So we follow only European option. So if you want to settle by delivery basis, you have to wait till expiry. If you want to exit before that, early execution, you have to exit by net basis. But for exam purposes, we will always exit on expiry for exam purpose. Practically, how do we trade? If I want to give one simple answer, how do I trade practically? Today, I buy the option at option premium. Tomorrow, option premium will change. I can exit at that price. If option premium increase, I make profit. If option premium reduce, I make loss. Yes, that is what net basis. That happens practically where you buy the option premium today, tomorrow option premium changes, at that price you exit. It's very simple that way. But what we are trying to understand here, theoretically, how this option premium is going to be calculated. What are the factors influencing this? Those things we want to understand. But before go to that level, what you have to understand here, option premium changes every day. And option premium is paid by one person, received by another person. When you pay option, you get the right on the expiry date. So let's just try to understand. You enter today, you exit on expiry date. So I'm only trying to make it very clear as far as theory is concerned. Then we'll come to more practicals. That is not there in syllabus, but here and there I will try to connect it. Okay. If I ask you this question other way around, see if you are able to answer. Suppose if the market price on expiry comes to 2540. Today you paid premium of 40 rupees. Today you paid a premium of 40 rupees. On expiry, you please tell me, will you be at a profit or will you be at a loss? I'll explain one requirement once more. Today you paid 40 rupees on a strike price of 2,500. On expiry, market price became 2540. Will you be at a profit or will you be at a loss? 2540 means what will happen? You will buy at 2,500 and you sell at 2540, you make a profit of 40. But profit of 40 rupees you make, you already paid 40. Effectively, no profit, no loss. So can I say like this? If you want to do a break-even point, if you want to have break-even point, then the market price should at least be strike price plus premium. That only will give you the break-even profitability situation. And also remember, if I change the strike price, premium will change. 2,600. Premium will change. Hope you are able to understand. Okay, I'll give a logic also, but before that, let me give a summary parts. Okay, now I'll try to write a summary in the charts. Let's see if we're able to understand. Different terms you have to be very clear. I'll go back to the PPT. Terms you have to be very clear first. Hope you understood the premium expiry date. Now, we have to understand there are different positions involved. Different positions. See, in futures, only two positions, long short, that's all. Future buy, future sell. Only two positions possible. In options, it is not like that. And in future, we trade in future prices. Future price changes every day, but in option, the option premium changes every day. Okay, so you have basically two types of option: call option, put option. Practical also I showed you. Example I just took only call option. I can also select put option. Now call option, you have two possibilities. One, you are a call option holder. Call option holder who will get or who will have the rights to buy the underlying assets on expiry at strike price. Call option holder, he is the buyer of the rights. Call option holder is the buyer of right. Now we call him as C plus, short form. C plus, you becoming call option holder. And then we have call option writer. Call option writer means you are having writer, okay, you are having obligation to sell. See, one person has the right, other person will have obligation. Obligation to sell underlying asset on expiry, that's called a European option, at a strike price, same strike price, at a strike price, at a strike price. This will be, this he is the seller of the rights. Seller of the right. Now put option also, put option holder, you will have put option holder. You will also have the right. What right? You have right to sell the underlying assets on expiry dates at strike price. Then put option writer, I mean this we call C plus, C minus. Put option holder we call them as P plus, P minus. Now put option writer, put option writer will have obligation. Writer will always have obligation. Obligation to buy underlying assets on expiry at strike price. I'll use short form, hope you understand. So put option writer, obligation to buy underlying asset at strike price. So put option holder is buyer of the option. Put option writer is seller of option. Seller of option. For call option holder, the intrinsic value formula, intrinsic value is given by market price on expiry minus strike price. Yes, he is the buyer of the option, but seller of the underlying asset. If you want to have right to sell, this right should be purchased. Hope you are able to get it. You are getting a right. Right means what? You decide to sell or you don't decide to sell. But for that right, you need to purchase. Right to sell. The right you need to have. For that right, you have to make a payment. So two instrument I told you in the previous chart also. You will have a you will have a option instrument. You have an underlying asset. Underlying asset is sold. Shares are sold. Index is sold. Commodity is sold. But the right you have to purchase. If you don't have the right, how can you sell it? If you want to have the right to sell, that right need to be purchased. So he is buyer or not of the instrument, buyer of the option. So we can say that call option exercised when the market price is less. Call option exercised when market price is less. Sorry, when the market price is more. When market price is more than the strike price, when market price is more, this option becomes cheaper. The option price becomes cheaper. Strike price becomes cheaper. So exercise when the market price is more, and that is called as intrinsic value, IV. You write the full form, IV, intrinsic value, the difference between MP, market price on expiry, minus SP, strike price. And remember, it cannot be zero. Why intrinsic value cannot be zero? Because if it is less than market strike price, if market price is less, I will not exercise. I have an option. That's the difference between option futures. So it cannot go below zero. So intrinsic value is market price minus strike price. Exercised when the market price is more. Put option exercised. Exercised by whom? Holder, not the writer. Exercised when market price is less. And intrinsic value is given by opposites, strike price minus market price. Strike price minus market price. And in general, payoff or net profit, that is given by intrinsic value minus premium. This is for the holder. For both types, this is for holder. And opposite for the writer. Intrinsic value minus premium is for writer. Premium minus intrinsic value is for holder. You just write for holder, opposite for writer. So take 2 minutes, glance it entire structure this. We have terms like option writer, option buyer, exercise price or strike price, expiry, intrinsic value, premium, payoff, C plus C minus, P plus P minus, MP, market price on expiry, SP strike price, the short form I give, MP is market price on expiry, SP is strike price. So this is just to make you understand the terms involved. Calculations part will go little bit later. But terms involved, if you have any doubt, get it clarified. Then I'll show you payoff graph and I'll show it to you. First term involved, take 2 minutes. It's okay for repetitions. Ultimately, 4 people's position should be clear. What is the position of call option holder? What is beneficial to him? What is not? Call option writer, what is beneficial to him? What is not? Put option holder and put option writer. These are the 4 positions possible. Their situations must be clear. All terms are associated with these type of 4 positions. In future by future sell, long short, that's all. In options, you're having 4 positions. This should also act as a very good summary point for you a day before exam and all. That's what this chart should serve the purpose. Some more small terms are there. I'll come to it, but this is the important terminology. Intrinsic value, when option is exercised. Okay, take 2 minutes, just glance it, see if you have any doubts. Also mention this is for holder and opposite for writer. This will be opposite because premium minus intrinsic value will be opposite for writer. And settlement also can be on delivery basis, settlement can be on net basis. Delivery basis means whatever strike price you make a payment, get the share. Net basis means differential, market price minus strike price, that is intrinsic value, will be used for net settlement basis. And those things we'll understand one by one. Okay, hope you are able to understand the basic terms. Okay, one simple example I'll give you. See if you're able to follow. Then I'll give a graph, payoff graph. Suppose, let's take a practical example only. Uh, Same example I gave you. Okay, Reliance shares. You can also write this example. Reliance shares. Strike price is 2,500. Option premium, call option premium is 40 rupees. Okay, now on expiry, suppose if market price is 2,600, how you should analyze? If market on expiry, if market price is 2,600, how should analyze? If purchased in the market, if purchased in market, this will cost you 2,500. Sorry, 2,600. If purchased in options, you already signed the agreement, then it will cost you 2,500. So where is it cheaper to buy? It is cheaper to buy in options. It is cheaper to buy in options. So what do? On expiry, you make a payment of 2,500, get the one share. This is what settlement by delivery basis means. Settlement by delivery basis. Settlement by delivery. But if you're thinking settlement on net basis, I don't think like this. I don't say where to a purchase, where I have a benefits. First of all, you say if market price is more than strike price, 2600 more than 2500, so option exercised. Option exercised. Now, if exercised, what is the benefit you get? If exercised, what do you get? You can buy at market, buy at strike price, buying the options at 2500 and sell in market at 2600. You get a profit, right? You buy in the options at 2500, sell in the market at 2600, you get a profit of 200. That profit is called as intrinsic value. That is 100 rupees. That is called as settlement on net basis. Settlement on net basis. Now, first of all, why you paid this premium 40 rupees? To get this benefit only, right? You paid this 40 rupees today so that you are expecting some profit on expiry dates, 100 rupees. That is payoff equals intrinsic value minus premium. Payoff 100, intrinsic value 100, premium 40, you get a benefit of 60 rupees. That's a benefit for the holder. This is payoff for holder. Writer opposite happens because for the writer, premium is inflow but intrinsic value is outflow. It's opposite for the writer. And suppose if the strike market price is not 2600, if the market price 2400, then what do you do? Will you buy 2500 and will you sell it at 2400? Why will you incur loss? So intrinsic value cannot become negative. If it is loss, I'll say I will not exercise. So if it is below 2500, the option is not exercised. Option is not exercised. Okay, hope you have taken down this example. I'll take it out. Okay, now let me tell you in different situations what will happen. Okay, let's take call option for the time being, then I'll go for put option. That's called as call option payoff graph. Call option payoff. I'll prepare a chart, then I'll go for a table. Call option payoff. Tabular presentation, I'll do prepare table, then I'll go for graph. And in my problems options, I'll follow one particular tabular format. Institute does not follow this, but I like standardization. So any problem in options, whether exercise or not, I'll follow this format. Okay. So these are the standard column I follow. One is market price on expiry, then payoff, intrinsic value, premium paid or premium, then payoff for holder and payoff for writer. Okay. Now same example I'll take, the Reliance example I've taken. Let's say market price on expiry, different situations I will have. Like 2000, 2200, 2300. 2,400, 2,500, 2,600, 2,700, 2,800. I'm just looking at different possibilities, okay? Market price and expiry, different possibilities. Now, if market price on expiry is 2000, what do you think will be the intrinsic value? I'm doing for a call option. Now, call option I think I've given. Intrinsic value will be market price on expiry minus strike price. Let's say strike price is 2500. Now, will you exercise the option first of all? You go to market, it is available at 2000. You come to option, option is higher. Why will you exercise? Or direct shortcut, market price is less. Option not exercised means intrinsic value 0. Don't do MP minus SP. Don't write minus number. This again 0. This again 0. This again 0. 2500? Yes, again 0. 2600. Market price is more. Exercise. So, what is intrinsic value? 2600 minus 2500, 100. This I showed you here calculation. Previous one, 100. You understand. And if market price goes up, 200. Again goes up. It is 300. Premium paid flat. I'll take 40 rupees in all the cases. All the cases. Flat 40 rupees. And what is the payoff now? 0 minus 40. Okay. For the holder, intrinsic value minus premium. 0 minus 40. Minus 40. Minus 40. Minus 40. Minus 40. Minus 40. Here you get 100 minus 40, 60. Here you get 160. Here you get 260. Okay. Now, payoff for the writer will be opposite. Very simple. Premium minus intrinsic value. So, it will be plus 40. Plus 40. Plus 40. Plus 40. Plus 40. Minus 60. Because the premium is inflow, intrinsic value is outflow. Minus 160. Minus 260. If I plot it on a graph, this is an important graph, please try to understand. So, y-axis we will have payoff, x-axis we will have market price on expiry. Market price on expiry. We'll start from 0, origin. Market price can be at various things like 2000, 2200, 2400, 2600, 2800. I'm not writing everything. Approximately I'm writing. Okay. Take a look at this now. I'm writing for the holder. What is this holder profit? Minus 40, minus 40, minus 40. It's becoming 40 only from 2600 onwards. So this is minus 40, minus 40, minus 40, right? 2500 also you can write. 2500. Somewhere in between. Okay. So his payoff graph will be flat like this. And after 2500, it will start increasing. Okay, it goes forever. Okay, so this is for, I'll say C plus, hope you understand. That is call option holder. Call option holder, I will call it as C plus. Payoff for writer, I will write as C minus. So what do you understand by this? This is loss is limited. And what about profit? As the market price increase, you get more and more profit. Unlimited profit. Unlimited profit. And when will you make profit? When the market price increases. Therefore, this is called as bullish in nature. Bullish in nature. The call option holder is bullish in nature. He makes more profit when the market price increases. What about the option writer? Exact opposite. He makes exact same profit when the market price is flat. And when the market price increases, he starts making loss. So this green one, this is for C minus. That is for option writer. He makes limited profit. He makes limited profit. And his loss is unlimited. Loss unlimited. So you make a loss when the market price goes up. That is why C minus is called as bearish view. Bearish view. So writer is actually taking a bearish view. When the market price goes left side, when the market price comes down, you make profit, but limited profit. This point, you know what is this point? This point is break even point, BP. For both of them same. And break even point is given by strike price plus premium. Strike price plus premium. This is the break even point at which both of them makes no profit, no loss. If break even points crossed us, the above this, holders start making profit, writers start making loss. Below this, opposite. This is a very good view of call option payoff chart and table. So chart you can visualize. The table should give you a clarity when exercised, what is intrinsic value, what is premium, and so on. We are going to replicate this chart for a put option as well. If you have any doubts, get it clarified. So when I say it's intrinsic value 0, that means option lapse. That remember, option lapse when the market price is less in case of call option, opposite in case of put option. Okay, shall I rewrite for put option? Any doubts on this one? I'll wait for 1 minutes. Okay, I'll go further. Let's say I'll do now for put option payoff, put option payoff. Put option payoff also I'll take similar one, but I'll reduce the market price on expiry. I don't want to write too many things. Okay, so first let me prepare table, then I'll go for graph. Same columns I'll do market price on expiry, intrinsic value, then premium, payoff for holder, payoff for writer, payoff for holder, payoff for writer. I'll take same thing, strike price 2500, premium I'll make it as 30 rupees. Call option premium, put option premium will not be equal, or what is the connection between the two, we'll discuss little bit later. And intrinsic value is what? Intrinsic value is strike price minus market price. And when exercised, market price is less, put option is exercised. So market price expiry, I'll say 2000, 2200, let's say 2400, 2500, I'll say 2600, 2800. I'll just say 5 items, that's sufficient. Premium 30 rupees everywhere. Intrinsic value, strike price minus market price. Strike price 2500 minus market price 2000, so you'll get 500. Here you get 300. Here you get 100. 2500 minus 2400. Here you don't get minus 100. Zero lapse. Zero lapse. Not exercised. So payoff of folder. Intrinsic value minus premium. 500 minus 30. 470. 300 minus 30. 270. 100 minus 30. 70. 0 minus 30. Minus 30. Minus 30. Opposite for writer. So plus 30 plus 30 minus 70 minus 270 minus 470. So let's put up the graph. Okay. So this is payoff. This is market price on expiry, origin. Okay. How the graph of a payoff of a put option holder? This is P plus, P minus. You see, he has a limited loss. He will have a limited loss when the market price is 2000, 2200, 2400, 2600, 2800. So he will have a limited loss. Okay. Now, what is the put option holder looks like? Initially, he had a profit of 470, then 270. So profit is coming down. So profit will come down. You can say here, then here. So profit will come down. His profit will go like this. Is try to draw a straight line. then something like this, then it will become flat. Hands are shaking, please try to draw straight line. It will cut after this, something like this. Okay, then you draw straight line. At 2500 it should take a turn. After strike price, it should take a turn. Okay, this is better. Assume it's a straight line. Okay, it become flat like this. So here also limited loss. Limited loss. This is put option holder P plus limited loss. Unlimited uh, profit. Almost unlimited profit. Almost unlimited profit. Why almost? Because theoretically, you cannot have share price going below zero. So theoretically, we say limited profit, but you should say unlimited profit when the market price comes down. So when the market price is less, you make profit. That is why it is called as bearish view. Put option holder will have a bearish view, P plus. Whereas put option writer, initially you make loss, and as the market price increase, you make profit, or you will have less and less loss. So just a reverse. So his things will go like this. Try to draw a straight line. This is again limited profit, almost unlimited loss. And where you make profit when the market price goes right side, market price goes up. So that's why it's called as, this is for P minus, put option writer. So this is bullish view. Bullish view. And break even point is given by strike price minus premium. There it was strike price plus premium. Here it is strike price minus premium. Okay, fine. Hope you've done till here. No questions. Okay, so fine. Hope you understood the payoff of call option, put option. Again, before we go to the next situation, let me take a look at certain calculations, see if you're able to do it correct, or I'll call this as strategies. So many strategies are there, but before I name a strategy, I'll take some example, numericals. Let's see if you're able to interpret, and based on that, I will be giving you the strategies. Okay. Now, let me give you some situations, numericals. Let's say, uh, again, all these things are assuming the expiry, settlement happens on expiry date. You hold till maturity. Practically, as I told you, you need not hold till maturity. You can exit anytime before that as well. Okay, fine. Let's say today, strike price. Simple example I'll take. Let's say thousands, and you're looking at, let's say, 3 month expiry. 3 months expiry, or 3 months futures. 3 month expiry. You became call option holder. You purchased call option. You purchased a call option by paying, let's say, rupees 60, and you also purchased call option. You became call option holder as well as you became put option holder. You purchased a put option by paying rupees, let's say, 40. You purchased call option also, you purchased put option also. Now, on expiry, I'll give you different situations. See if you're able to calculate the overall profit or gain. Okay? On expiry, market price. I'll imagine three situations. Suppose if it is 800s, if it is thousands, let's say if it is 1200. Now, before I calculate, can you think and calculate? If market price is 800, what will be your overall position? Okay, well, let me do one thing. I'll give a format. You know, you have a call option as well as put option. You become a call option holder, C plus. You become a put option holder, P plus. So, two columns I have to prepare. What is that? You have intrinsic value. I'll use short form. Hope you understand. Then minus premium. You will get payoff. This is for call option holder. And you also are having put option holder. So I repeat this column: intrinsic value, premium, and payoff. This is for being put option holder. Put option holder. So we have one payoff being a call option holder position, one payoff being a put option holder position. Then we are going to have overall position. Overall. So in this case, what and all will you calculate? Remember the basics. For both of them, strike price is 1000. When the market price is less, call option not call up when the market price is less, call option not exercised, put option exercised. When the market price is more than the strike price, call option exercised, put option not exercised. I'll repeat once more. When the market price is more, call option exercised. When the market price is less, put option exercised. So when market price 800, option not exercised, you are a holder. 0 intrinsic value. 1000, 0. 1200, you will get intrinsic value of 200 rupees. Premium, you already paid 60 rupees, 60 rupees, 60 rupees. Payoff 0 minus 60 minus 60 minus 60 plus 140. That completes the call option holder position. Put option holder position. Put option holder position. Call option, put option is exercised when the market price is less. 8, that is 1000 minus 800, 200. This is 0. When the market price is more, put option not exercised. You paid a premium 40, 40, 40. Intense coil minus premium because you're holder. 200 minus 40, 160. This is minus 40. This is minus 40. So overall payoff minus 60 plus 160 plus 100, minus 60 minus 40 minus 100 plus 140 minus 140 plus 100. Now I would like to represent in the graph this market price and this overall payoff. I'll write in the next slide. So please make sure you written the table here. Let me know if you have any doubt. This is called as strategy. I'll tell you the name of the strategy later, but let me put it in the graph. Let's do interpretation. Then I'll tell you the different strategy names. If you have any doubt, get clarified. If it's fine, I'll go to the next slide. Okay, hope it is fine. Now I'll put this in the graph. Okay, try to draw a straight line. So x-axis we have payoff, y-axis we have market price on expiry 0. I'm looking at three situations, which is 800, 1000, 1200, 800, 1000, 1200. What are the profits or loss you are getting? For 800, you have a profit of 100. So when market price 800, you got a profit of 100 plus 100. Let's say this points. And when we have got a market price 1000, you got a loss of 100. So minus 100 when you have a loss of 1000. And when it's 1200, again you have a profit of 100, which will be something like this. So if you join the points, it will happen like this. You can extend further. You can extend further. Draw a straight line as far as possible. Okay. It's kind of V shape. This is called as, actually there is a name for this strategy. This strategy name is called as long straddle. Long straddle. Straddle long. Now what is this number means? This, when at market price you get a maximum loss. When the market price goes beyond certain level, you make profit, unlimited profit. And here also, when market price goes below, you make unlimited profit. Sorry, unlimited profit, yes. But when the market price exactly remains same, there we get maximum loss. Such a beautiful strategy. Try to understand. When will you make profit? If the market remains same, you don't make profit. If the market moves up drastically, you make profit. If the market price comes down drastically, you make profit. In fact, what is this cutoff point? On the upper side is where call option is exercised. You know what is the break-even point for call option? Strike price plus premium. So strike price 1000 plus premium, total premium. Don't take only call option. Total premium 40 plus 60, 100 rupees. So this is 1100 actually. 100, 1000 plus 100, 1100. This is the break even point. On the lower side, similarly, it is strike price minus premium. So 1000 minus 100 total premium. So this will be 900. Which means between 900 market price 900 to 1100 you make loss. Below 900 or above 1100 you make profit. You see, if the market price goes up also you make profit. If the market price comes down also you make profit. What an amazing strategy. But when will you make loss? If the price is stagnant between a two particular price. So you can apply this strategy on days like budget day. You know, budget, if it is good, market shoots up very high. Or it's little bit of disappointment, market can fall drastically. We can apply even this on situation like on a result day. If result is satisfied, market price can shoot up. If the result is disappointing, market price can fall sharply when news comes, when a lot of confusion is there, where price can move in that direction. Buy both. If the price move violently, you make profit. If the price is soft, you make loss. It's called as long straddle, where you take a position of, you become call option holder as well as put option holder at the same strike price and same expiry, expiring on same date. If you take different expiry, then it's called as a calendar spread. We'll come to it later. So long straddle, where you buy call option, you buy put option, and you will have a chart looking like this. I'm going to show you summary of all the strategy now in a quick manner. But before that, please write down this basic example and let me know if you have any doubt. This strategy name is long straddle. You buy call option, you buy put option. You become call option holder, you become put option holder. Okay, hope you have taken it down. Okay, now this is called as long straddle. Now, what if it is called a short straddle? I become call option writer and put option writer. The formula or the format will be exact reverse. So let me give the summary quickly. The strategy name, whatever the transactions involved, and how the graph will look like. In the exam, you will not get a full-fledged problem on strategy. Just 1 second. Okay, till it opens. In the exam, you will not get full-fledged problem on strategy. They will not ask you, say, identify the strategy. Like that, they will not tell you. Either they'll give a series of transaction or they'll ask you a theory question. But practically, being a trader, I can tell you, I use it on day-to-day basis. This different strategy. So practically, it has got more relevance. Examination, this strategy has got very less relevance. So only one strategy. I showed you the payoff graph calculation and all. Remaining strategy, I'll give a quick summary of it. Sufficient from exam point of view. Okay, so as I told you, from exam point of view, if you know the summary of strategy is sufficient, so I'll quickly give you a summary. Strategy, transactions, and quick graph. Okay, strategy is long straddle. This is the name. And transactions, you buy call option, you buy put option at the same strike price, at same strike price, and same expiry. Same expiry. So this graph will look like this payoff graph. You will have a V-shaped kind of thing. This is long straddle. If it is short straddle, you do opposite. You sell call option and you sell put option at same strike price. Same strike price. I'll say SP. Hope you understand. At same expiry. This is called as short straddle, where the graph will be exactly reverse, inverted. So what is the interpretation? Between the two price, you make profit. If the market price stays between the break-even points, you make profit. If it goes dramatically, comes down dramatically, both cases, you end up loss. Between the particular range, you make good profit. Long straddle. Then we have long strangle. Remember easily, this D we have learned first, then G, alphabetically G comes later. So strangle. What is this? Exactly the same thing. Only difference is here we took at the same strike price, right? Here we'll do it at a different strike price. So here you are going to do buy put at lower strike price. I'll say SP. Hope you understand. SP strike price. Sell. Sorry, buy call option at a higher strike price, but same expiry, and this is called as long strangle. It looks like a V shape, but you will have a some flat like this. Means one flat line will come. So if that flat line, you will have a maximum loss where you don't exercise call, you don't exercise put. You know, lower strike price, higher strike price. Call, put and call. Between that range, both are not exercised. So you'll get on flat line like a tub kind of thing. Like a V shape, but you will have a flat line. So line comes down, flat line, then going up. It's long strangle. If I do reverse, it's short strangle. Short strangle means I will do a sell put at lower strike price and sell call at higher strike price and same expiry, and this is called as short strangle. So this will come in a reverse manner graph. So in the exam, if they ask you theory question, first of all, they can ask one theory question, or they can ask you name few strategies. If they ask you long triangle, you write long straddle, you write the name, you write the transactions, show the graph, show a numerical example like the way I showed you. Like this, applicable for any other strategies. So long straddle at the same strike price, long strangle at a different strike price. Long strangle, I buy both. Short means I sell both. Same thing, long strangle, I buy both call and put. In short strangle, I sell both call and put. Okay, hope you've taken it down. So let me do a few more strategies quickly for you. Strategy, again, not in detailed calculation, a summary calculation only. Whatever transactions or positions we take and how the graph will look like, payoff graph. So we have called as spreads. We have bull spreads with call. We have bull spread with put. Then bear spread with call, bear spread with put. With put. Now bull spread with call. Now I take two, only using a call. Only using a call, but I take two positions. Bull spread with call. So what I do is, at a lower strike price, you buy call. At lower strike price, you buy call. At higher strike price, you sell call. We also have ratio spread, and for this strangle straddle, if you take a hedge on both sides, it's called as the iron fly, iron condor. There is no end to it. So many strategies are there, but I'm trying to give you what is very relevant that can come in your exam, that too for theory purpose. Okay, so how does the graph will look like? Bull spread with call. So you have a limited loss when the market price is down. You have a limited profit when the market price is up. Spread, creating a difference. Bull spread with puts at lower strike price. Same. I buy put option and at higher strike price, I sell put option. Forgot to tell, this is again same expiry. This graph also will look alike. Similar only it will look like. You will have a limited profit when the market, limited loss if the price is down, limited profit when the price is up. Bear spread with call, opposite. You make profit when the market price comes down. At a higher strike price, you sell call. at a lower strike price, so at a higher strike price, you buy call. At a higher strike price, you buy call. At a lower strike price, you sell call. So this is again on same expiry. Again, different expiry means calendar spread that I'm not going to show it to you. And bear spread with put, again the graph will look like you make profit when the market is down and you make loss when the market goes up. This is again at a higher strike price. You buy put. At lower strike price, you sell puts. On the same expiry, you get a similar graph that is in bear spread. So if they ask you which strategy gives you limited profit, limited loss, you have to select spread. Which strategy is bear? When the market comes down, you make profit. Either bull spread with, when the market comes down, either you tell bear spread with call or you can tell bear spread with put. So this will give you profit when the market is down. Bull spread means when the market is up. So when I say spread, you should use either only call or you should use only put at a lower strike price, at a higher strike price. We also have butterfly strategy with call. The graph will look like something like this. Butterfly strategy with call. It looks like a butterfly, it seems. We have calendar spread, iron fly, iron condor, ratio spread. So many strategy we use in practical life. I don't want to go in detail. This much, if you know, more than sufficient. To be specific, if at all you should remember, that is long straddle, the example I gave you. That much you remember sufficient from exam point of view. Okay, so this is all about now strategies. So we have understood the terms and the summary of strategies, though not in detail. Approximately from exam point of view, what is required, strategies we have discussed. Okay, now we are going to understand a very important term from exam point of view. What we discuss now onwards is purely from exam point of view. So please pay attention to these things. We have put, call, parity, theorem. You remember parity? What do you mean by parity? Parity means equal. You remember in futures we discussed fair value of futures and the spot market. We compare if fair value and the future price both are equal, then there is no arbitrage gain. If it is not equal, then there is arbitrage gain. Remember that theorem corresponding to future we have in options. So put call parity theorem means what is the fairness, what is the fair value. They connect four things. So as per put call parity theorem, formula is given by value of call plus present value of strike price or exercise price equals value of put plus current market price of the underlying asset. So value of call, this is call option premium, HP, that is present value of strike price, present value of exercise price, strike price, and value of put option premium, put option premium, and current market price. That is current price of underlying asset. All of them should be at same underlying asset, same expiry. Current price of underlying asset. So if this is equal, so this left hand side, if it is equal to this right hand side, if equal, then means what? No arbitrage opportunity. So if put call parity theorem exists, if equal, PCPT, put call parity theorem exists and no arbitrage opportunity. No arbitrage opportunity. Of course, if not equal, there exist arbitrage opportunity. There exists arbitrage opportunity. So how do you construct arbitrage opportunity? What transactions to be done today? What transactions will happen on expiry? I'm going to show you all of them. I'm going to show you tabular presentation as well. First you write down this. So put call parity theorem connects four variables of same underlying asset. Okay, all of them should be of same underlying assets and same expiry dates and same strike price also. I mean, we are doing for a one single strike price. For different strike prices, we can't take different premium. So for a strike price, what is call option premium, put option premium, what is strike price, and what is the current market price of the current asset of the same expiry date. We are trying to connect four variables. Connection between these four variables: call option price, put option price, premium, current market price, and strike price. If this connection does not exist, if it is not equal, we have an arbitrage opportunity. So write down, then I'll give you the short form. I'll give you the arbitrage process. First you write down arbitrage process. Okay. Hope you are able to write down till here. Now, arbitrage process. Arbitrage transactions. I will not go too much in detail. I will not go for the theory, formula and all. Just the process, direct shortcut. Arbitrage process. Now, two things can happen. If it is not equal, then only the arbitrage exists. Not equal means what? If left hand side is greater or right hand side is greater. Only two situations possible. Okay, so two situations possible. So scenario one, we have value of call plus present value of strike price. This is greater than left hand side, greater than right hand side, which is value of put plus current market price. Correct? This is one situation. Then I'll come to second scenario, scenario 2. Value of puts, value of call plus present value of strike price. This is lesser than value of put plus current market price. Okay, only these two are possible. Now, very simple rule. Remember this shortcut. This shortcut is not available anywhere in any textbook, any classes. I can tell you confidently. Learn this arbitrage process clearly. Now, when something is high, what is arbitrage process? What is the concept of arbitrage? Two markets are there. You buy in one market, you sell in another market. Buy at a cheaper price, sell at a higher price. Thereby, you get guaranteed profit, riskless profit, certain profit. Now, here, which side is high? In the first scenario, left hand side is high. So, this one you sell. The right hand side is less, cheaper. So, this one you buy. Simple rule. Similarly, in scenario 2, left hand side is less, so this you are going to buy, and right hand side is more, you are going to sell. So you will have two columns basically, what position you take today and what position you take it on expiry, at expiry. And you will have four markets. You know, in future, we had three markets: spot, future, money, SFM. Easy to remember. But here in future, I have two kinds. One is call up separately, put separately. So take a look at this one format, what we are going to do. So I'm going to write what position I take it in call option, what position I take it in put option, on what I take it in money market, and what I do it in spot market. So spot markets and what I do in money market. Same thing you do. Six is this also. Second scenario also. What do you do today? What do you do at expiry? In call, what do you do? In put, what do you do? In spot market, what do you do? In money market, what do you do? Spot market, current market price, or let's say on shares. Instead of spot, you say on shares, what do you do? And these four are not new things. These four is what is this put call parity theorem, right? Value of call comes. Present value of strike price, that's what money comes. Value of put, that's what put option. Current market price, that's what shares, underlying asset. Okay. Now, this much is clear. What transactions you do today, what transactions you do on expiry, in call put, in shares money, and if left hand side is less, you buy left hand side, right side you sell, reverse if right hand side is less. So in first situation, left hand side is more, you sell. So what do you do in call? Call you sell. Means what? You become call option writer. Now, what will happen in put option? Put option you buy means you become put option holder. Put option holder. On shares, what we do? Look at very share, current market price buy. So you're going to buy shares in the spot market. And if you want to buy shares on money market, what you should do? Remember basics. If you want to buy shares, you have to borrow money. You have to borrow money. And of these things, this will be just a closure. On expiry, if market prices, you do under two situations. If market price is increasing, what happens? If market price is decreasing, what happens? That we'll see later. But just understand what transactions should be done today. These are all just a consequence. Like you borrow money, you repay money. You buy shares, later you sell shares. That is just a corresponding thing. That should not be worrying you. But what transactions to be taken today, there you have to be careful. So call option writer, put option holder, buy shares and borrow money. Now let's fill up the second one. What would happen in this situation? Call option. Here what will happen? Just take a look at this. Left hand side is cheap. So you are going to buy call option. So you become call option holder. Call option holder. And what will happen to put option? Put option you are selling. Right hand side, higher side, selling. So you are put option writer. And on shares, what you do? On shares, you have to sell. So you have to borrow and sell. Short position. You have to borrow and sell shares. So basically, short position. And money, what you are going to do? Money buy means it's asset. So you are going to write it as deposit. In short position, once you sell the share, you will deposit. Of course, all these consequence will happen on expiry. Consequence, if market price up, if market price down, we are going to calculate the overall calculations. Calculations part, we'll keep it separate. So this is the summary of arbitrage process in one slide. Of course, numericals, you'll understand better that you handle separately. So objective of this one is, even if later you want to summarize, it is available in one place. Of course, after solving problem, re-look at this chart, re-look at this format, you will get a better control. Any questions you have on put call parity theorem? Okay, so we have done with the basics of options terminologies. Option payoff graph and all we understood. Options strategies summary we looked at, and arbitrage process put call parity theorem. And remember, all these options future will again come in next chapter. Interest rate management again will come in forex chapter. So these are all the things you cannot forget. Huh? You have to remember. So derivative will not get over so easily. This will come in other chapters also. Okay, hope you are done. Now we'll come to the most important factor. You can say practical as well as theoretical. Examination also, these are important. Practically, if you want to trade in options, these things you have to understand, which is a necessity. That is, what factors affecting option premium. So my point is, how do you calculate option premium? It's also called as option price. Option price. Option price. What factors do you think will affect option premium? First of all, when is option premium paid or received? That is today. Hope you know the basics. So today, option premium is paid. Option premium is paid. But when do you get the benefit? Of course, when you exit, you get the benefit, or you remain till maturity. On maturity. On maturity. On maturity. On expiry. Okay. What benefit you get? So if I say option premium is the outflow, it's what you pay, what you get on expiry. Can you tell me what is the term? In future, I buy on expiry square of difference is my profit. But in option, at the beginning, I make a payment, option premium, that's called option price. But on expiry, what benefit I get? What is it called as? That is called as intrinsic value. That is called as intrinsic value. And what is intrinsic value? Let's say I'm talking for call option, that is market price minus strike price. Now, market price minus strike price is the intrinsic value I get. That's a benefit I get, right? This is what you receive from a holder point of view. Opposite will be for a writer. But is it happening at same point in time? So you have to definitely adjust time value of money, right? Time value of money is actually called as extrinsic value. Anyway, time value of money. So what are the factors that will influence in time value of money? In time value of money, you need a time to expiry, remaining time to expiry, and you have rate of interest, risk-free interest, rate of interest. Now, strike price is fixed, we know. Time to expiry is known in advance. Rate of interest, kind of we know, it does not change much. But what about market price? Market price will not remain same, right? Market price keeps fluctuating. Now, how do we know what is the market price today itself? We will not be knowing. So, for market price, estimation of market price today purposes, we apply concept of probability, and the move deviation, that is risk, is applied in standard deviation or risk. So if some stock is high risk, it commands higher premium. So these are the various factors affecting option premium. That is time to expiry, rate of interest, probability or risk, or we call it as uh, whatever, delta or rho or gamma, whatever it is. Time to expiry, rate of interest, probability, standard deviation, market price, strike price. These are the factors which will influence option premium. But basic structure, did you understand? In the option premium is what you pay, and what value you get, that is intrinsic value. Intrinsic value. Please write it down. Factors affecting option premium. Now then after this I'll go for option models. Which option model? How to value the option premium. Again, they are models, theoreticals, practically only we know it in practical life. Okay, hope you've taken it down. Next, option valuation models. Option valuation models. Broadly, we have two methods. One is binomial model. Then we have Black-Scholes model. Binomial model, and then we have Black-Scholes model. I'll explain both. Now, in binomial model, there are two approaches. One approach we have called as portfolio replication approach. Portfolio replication approach. And we have risk neutrality approach. Risk neutrality approach. Risk neutrality approach. And in binomial model, basic assumption is we will have only two possible market price on expiry. Two possible market price on expiry. That's a basic assumption. But practically that's not the case. So we have a statistical model, Black-Scholes model, we have multiple possible market price on expiry. Multiple possible market price. Black-Scholes model. Okay. In portfolio replication approach, we compute one very important term that's called as delta. I'll explain what is that. And in this neutrality approach, we compute something called as risk neutral probability. And both are not equal. The formula looks very similar, but both are not equal. In Black-Scholes model, we are going to apply factors such as normal distribution and natural logarithm factor, natural logarithm, because it's a statistical model. So we need these basics to understand about Black-Scholes model. I'll explain, don't worry. And at the end, we have something called as Greeks. Last, we have something called as Greeks, which basically theory for you in exam. If one factors change, how the option premium will change. That's called as option Greeks. I'll explain one by one, don't worry. Okay. Now, let me come to the binomial model. To be specific, I'll do the portfolio replication approach. So what I'll do, this portfolio replication approach and binomial model, I'll do it in a columnar format, so that you understand that what is the difference between those two very clearly. So binomial model, how we are going to follow it, what process we follow under portfolio replication approach, and how do we follow, what steps we follow under risk neutrality approach. Okay. In portfolio replication approach, we always compute delta of call, or you can compute delta of put, but I'll do delta of call. Delta of call is given by, they say, C1 minus C2, delta of call is given by C1 minus C2 by S1 minus S2. So basically C1 minus C2 is spread in intrinsic value of call option divided by spread in spot price. Spread in spot price. So basically delta will tell you uh, it's a fractional share, you can say. You can understand as fractional shares. I'll quickly tell you what is that. See, we have one underlying asset. We have options. I mix the options and underlying asset. I mix the option and underlying asset such a way that portfolio becomes risk free. So I'm mixing the two, underlying asset and options. So for one underlying asset, how many shares, how many options I need to have? That's what is fractional share. So fractional share, this represents basically risk of one option is equal to risk of how many shares, dash 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 shares, delta shares. So if I tell you delta equals to 0.6, I can understand the risk of one share is equal to risk of 0.6 option, or risk of one option is equal to risk of zero point 0.6 shares. Or you can also understand, this is delta, you can also understand by uh, change in option premium with respect to spot price change, with respect to change in underlying asset, with respect to change in spot price, with respect to change in spot price. Means if I tell you delta is 0.6, If the spot price changes by 1%, the call option premium will change by 0.6%. The you know what is beta? What is beta? Beta is if market changes, how much my portfolio will change, how much my security change. Now delta means if the spot price changes, how much option premium will change. That's what is delta of call. If you want delta of puts, that's always negative. That is delta of call minus 1. It's always negative because delta of put against, it's a put option, right? Ready to sell. It goes against the market price. So it's a negative always. Delta of call minus 1. Okay. So portfolio replication is that. Delta of call you calculate first. And second step you calculate is on expiry, the portfolio value will be same. Portfolio value will be equal. Let me show you that. First, you write down the delta of call. I'll show you numerical as well. Hope you understand better there. So, this is first step. Second step, what you calculate? You make portfolio equal. You make portfolio risk free. Make portfolio risk free. So you can do it in multiple ways. I'll show you easier way. What you can do, value of call, that is what you're going to calculate. Call option premium is current portfolio. That is whatever current spot price into delta of call into the spot price. You get current portfolio minus present value of the portfolio if the price is falling down. So delta of call into low price divided by 1 plus R. That's all the formula. So current, this is delta C into spot means current portfolio. This is current portfolio. This is current portfolio. And this is present value of risk-free portfolio. Present value of portfolio. Present value of portfolio at lower price. At lower price. You can also do it at higher price, but it's straightforward. You can do present value of portfolio at lower price. For derivation, you don't worry. So this is the steps under portfolio replication approach. Under risk neutrality approach, what do? We calculate something called as probability, risk neutral probability. Risk neutral probability. That is given by R minus D divided by U plus D. R you understand, that is 1 plus rate of interest. R is rate of interest, 1 plus R. D is 1 minus percentage down. U is 1 plus percentage up. You understand? P is R 1 plus R. They'll tell you the price can be up by 20% or can be down by 20%. Up by 20% means it is 1.2, 1 plus 0.2. Down by 20% means 1 minus 0.2. So D will be 0.8, 1 minus 0.2. R will be 1 plus 0.2, it will be 1.2. That's what is probability. Risk neutral probability. What do you mean by risk neutral probability? Probability such a way that the risk-free asset and the underlying asset both are treated equally. This is not regular probability, it is risk-free probability. At this probability, both risks are same. Risk neutral, no difference. So delta is different, probability is different, formula looks alike, just be careful. This is first step. And second step, how do you calculate risk neutral probability? Simple formula, you calculate present value of expected intrinsic value. Interesting name. Present value of expected intrinsic value. So on expiry, how do you calculate present value? Let's say value of call option. When the market price is up, I'll say high price. minus strike price, right? This is your intrinsic value, market price minus strike price, multiplied by probability into P plus low price, that is the expected value, you understand, value multiplied by probability. So high price minus strike price is done. When the market price is less, it's usually not exercised, but I'll just say 0, not exercised, into 1 minus probability. Why I'm writing 0? Because if it is a put option, here the strike price minus the low price will come. Put option is exercised when the market price is less. So this is expected intrinsic value divided by 1 plus R. That will give me the value of call option. Now from the value of call option, I can do using put call parity theorem, I can compute the value of put option. From the call option, I can compute the value of put option. Write down this theory part, numericals we'll see later. I'm just trying to give everything in one place. I know it can be slightly more extra pressure on your mind, but this will be useful when you do a proper summary. And when you do problems, you refer this, or after doing problems, you use this for revision purpose. It looks very similar. Many people are confused between probability and delta, so I wanted to give a comparison number clearly. Okay, binomial model. Sometime in the exam, they'll ask you quite a few times. I'll say 2-period binomial model. 2-period binomial model. So in that case, how to solve the problems? That also I'll give you steps. Numericals you can see later. So first step is to compute probability, risk neutral probability, risk neutral probability. Second step is to compute. Okay, let me explain the logic quickly. Hopefully you will be able to understand better. Then you can write down the steps. I'll give time, don't worry. Okay, understand two-period binomial model. Spot, suppose 100 rupees. If it increase by 10%, it becomes 110. Decrease by 10%, it becomes 90. Now this 110, if it increases further by 10%, it becomes 10% on 110, 121. And decrease by 10%, it becomes 99. 110 minus 11, 99. Similarly, 90, if it increase by 10%, that is 99. 90, if it decrease by 10%, that becomes 81. This is a two-period binomial model on spot price. So what do we do? In two-period binomial model problems, first we compute the spot price, dividing into 4 parts like this. From today, half, then next half. That is, if the contract is 6 months, so from today, what will happen after 3 months and then after 3 more months? Divide the parts into 2 parts, 2 period. If the contract period is 1 year, I'll divide into 6 months, 6 months. By doing this, I will get the 4 possible market price. Now from the 4 possible market price, I reverse and I'll do the present value for option premium. I'll do once more. I like this animation. So first one, what we do, from the left to right, we calculate the spot price. What can happen after one period? What can happen after two period? I will know the spot price, market price. Now, based on the market price, I compute the intrinsic value and I came backwards. Observe the chart. What was left to right, I'll make it as right to left. I'll do it once more. So, spot price, left to right, and the option premium, right to left. That's what I'm going to get it as the option premium calculation. And how do we calculate? Now, two numbers are there, two boxes are there. How do we make it into one? We apply expected value, that is probability. And how do we come back one period at a time? We apply interest rate, present value concept. Again, last two circles, apply probability, apply interest rate, I come back. And again, we have two circles now. Apply probability, you get one circle, come back, you get the present value. Let me explain, then you can take down this chart. We follow this two period binomial model. Two periods binomial model in three steps. First step, risk neutral probability. Second step, stocks at expiry. Third step, computing the value of call. Now, risk neutral probability, what is the formula? You can do F minus L by H minus L, or using the institute format, R minus D by U minus D. R is, 1 plus R, D for 1 minus percentage down, and U for 1 plus percentage up. And remember, this is for single period only. For single period. So if I divide the 6 months into 3 months, 3 months, this probability is applicable one term at a time, 3 months at a time. You should calculate for single period, for one term. For single period, for one term. Okay. Then spot price on expiry. How I'm going to calculate? I'll start with S0, spot price 0. And after one term, I'll make it as S1, S2, or they'll use the word SUSD. In the first term, spot price up and down, up and down, SUSD. Again, further up, down, further up, down. It's called as SUU, market price up in the first term and up in the second term, UU. Then SUD, up in the first term, then down. Spot DU, DU, down and then up. SUD, up and then down. So you do for spot price. Similar thing you do for value of call. What you are going to do? This is going to be value of call. This will be divided into two parts, which is CU and CD. Value of call. If it is put option, you should use C. You should use P. Then this will be calculated based on CUU, CUD, then CDU and CUD. But this will work reverse, okay? In a reverse manner. This will come back basically. Okay. Now CUU, how do you calculate? The spot price and strike price difference. That is market price SUU minus strike price. Market price minus strike price. This is call option. Put option means reverse. Same thing. Just similarly, dot dot. So you understand CUD minus strike price, all those things. So we get the 4 intrinsic value. Now this number I'm going to multiply it by probability. Probability of going up is P. Probability of coming down is 1 minus P. How do you calculate probability? In the first step. This also probability of going up is P. Coming down is 1 minus P. Going up is P. Coming down is 1 minus P. So how do we calculate CU? That is CUU, that is intrinsic value, multiplied by probability plus CUD multiplied by 1 minus probability. This will give me expected value divided by 1 plus R. I come back. Similarly, CD is CDU multiplied by probability plus C U D or DD. Okay, this is C DD actually, last one, DD into 1 minus P whole divided by 1 plus R. Don't get confused by this terminologies, just understand the process. We have 4 values, we bring it down to 2 values by applying probability and dividing by 1 plus 4. 2 values we have, again multiply by probability, divide 1 plus R, you get value of call. So value of call, same process, CU into probability plus CD into 1 minus probability whole divided by 1 plus R, that is your value of call. Again, at this point in time, you may not be able to appreciate this much, but once you do a problem, refer these steps once more, I am sure you will be appreciating this. Shortcut to remember 4, 2, 1. You will have 4 intrinsic values, then 2 intrinsic values, 1 intrinsic value. 4, 2, 1. From the 4 market price, 4 intrinsic value. Then 4 we make it into 2, applying probability, discounting it. Then this 2 will again be further make it into 1 by applying probability and discounting factor 1 plus R rate of interest. If it is compound interest, continuously compounding, I will not do 1 plus R, I will do e power RT. Or to be specific, you can do e power RT if it is continuous compounding. Okay, very good. So this is about binomial model, portfolio replication approach, binomial model under risk neutrality approach, and 2-period binomial model problems. We have one more important one, that is Black-Scholes approach. Let me explain that. Okay, Black-Scholes model. It has some assumptions. It is European, exists only on expiry, normal assumption. No dividends are paid, efficient market, everybody is aware of all the information, no commission, no brokerage, no transaction charges, risk-free and volatility, that is standard deviation, are constant. It follows log normal distribution, that is a statistical model based calculation. Anyway, before we go to the formula of Black-Scholes model, I would like to quickly cover some basics of normal curve. I know you might remember or you might not even heard of it, does not matter. I'll quickly explain normal curve basics. Normal curve is a bell-shaped curve where left extreme is minus infinity, right extreme is plus infinity, and at the exact middle point we have 0. This is like what is the probability of like marks of students, weights of students, salary of people, they're all on x-axis. And y-axis, this y-axis or this area under the curve represents probability. So area under the curve is probability. So total area is what? Total probability. So total area is 1. And it has got one important property called as symmetrical property. What is symmetrical property? Left side and right side are reflection of each other. Symmetrical property. Left side, right side are reflection of each other, and in fact the left side of the curve covers 50% of the area, 0.5. Right side of the curve covers 50% of the area, 0.5. Now, why normal curve is used in Black-Scholes model? We need to find out the probability. And how the probability works, that is minus infinity to plus number something. Suppose it is minus infinity to 1. They will give you area from minus infinity to 1, 0.9772, something like that. We'd use that. But sometimes they'll give you area from minus infinity to something or minus infinity to plus 1. I don't require infinity to 1. I need minus 1. I'll tell you once more. In Black-Scholes model, we need area from starting from minus infinity till a particular point. Till particular point. So if in the question only they give minus infinity, no problem. But if the question gives you starting from infinity to 1, let's say infinity to 1 is 0.0116. But I don't want infinity to 1. I want minus infinity. Then what should I do? I should do minus. 1 minus. So if starting point is from infinity, then what you should do? 1 minus such probability. That's all you have to do. 1 minus such probability. That's all the basics of normal curve you require. I repeat once more, normal curve represents the area of probability. Starting from minus infinity till plus infinity, middle value being 0. In Black-Scholes, it uses starting point being minus infinity. So if the starting point is minus infinity, no need to worry. Use the problem as it is. If the starting point is plus infinity, then we need to convert. How do we convert? Do 1 minus probability. One more interest situation will happen. I'll tell you now. Take a look at this. They have given this z value. Then they have given this area. Area means probability. Now, probability, they're very tricky. They're not telling, are you starting from minus infinity or starting from plus infinity? They're very clever. That case, you have to identify. How do you identify it? When the area is decreasing, right? When the area is decreasing, look at this example. Where is decreasing? That means starting point is infinity. 0.4013, 0.3821, 0.2912. Area is decreasing. That means starting point is infinity. We are moving to a right side. We are getting less area. So if the starting point is decreasing, if the probability is decreasing, that means starting point is infinity. But what we require, starting point is minus infinity. So what should I do for all these things? 1 minus, 1 minus, 1 minus, 1 minus. When I do this, I get area from minus infinity. So the area is decreasing, starting it is infinity, I should do 1 minus of probability. If the area is decreasing, then no need to worry. That itself is area from minus infinity, I'll take it as it is. So you should be careful. If the area is decreasing, you should do 1 minus. And one more situation also will happen. They will give you for 0.25 equal to this is probability, 0.3 means this is probability. Then they'll ask you, okay, z is 0.28. In between, we need to find. We follow interpolation method. Basics we discussed. Interpolation method, that is from this to this, what is the difference? From this to this, what is the difference? Difference in rates by difference in present value multiplied by the value at lower number. Remember that interpolation method. So if z values are not directly given, then we might have to apply the interpolation method. Please recheck our discussion in the basics chapter. Okay, so this is the summary of normal curve required in Black-Scholes. What's the formula for Black-Scholes? Let me explain. I know many people will get a heart attack after seeing this, but one formula can get you 5 marks in the exam. Save the exam. Why should you leave it? After all, 5-10 minutes you by heart, you'll remember the formula. I'll try my level best to give you the shortcut as well. So value of call option premium equals S into ND1. S represents spot price. ND1 normal curve. Normal area. Area under normal curve. Probability from normal curve. X stands for strike price. X E minus RT, exponential or rate of interest T time number of years. That I need not full form, I need not give you. Then ND2, again area, probability from normal curve. So why this is also same thing? That's also same thing, huh? This is starting from minus infinity till d1. This is starting from minus infinity till d2. D1 value, what is the normal curve value? D2 value, what is normal curve value? How do you calculate d1, d2? I'll come to it. First, let me tell you little bit logic. Now, call option. Remember what's the primary formula of call option? Intrinsic value. What is the intrinsic value of call option? Market price minus strike price, correct? Now, strike price will happen later. So, you remember this formula as market price minus present value of strike price. Market price, spot price. Present value of strike price x into e power minus rt. How it's present value? Yes. How do you calculate present value? Future value by e power rt and future value by 1 plus r. And if I take this numerator, that becomes e power minus rt. When I take this denominator to numerator, minus becomes plus. So this is nothing but, remember, this part, you remember, this is market price, this is present value of strike price. X is strike price into present value of strike price, e power minus rt. When I divide by e power rt is same as multiplying by e power minus rt. That is basically applying me present value of strike price. Then how do you calculate D1? For that you should put little bit of efforts. D1 formula is given by ln s by x, not in, it's ln, natural logarithm, ln s by x, s spot price, x strike price, I told you already, or rate of interest, standard deviation square by 2 into t, 10 years, divided by sigma root t. D2 is D1 minus sigma root t. And where do you get ND1? And where do you get ND2? That you get it from normal curve table. And usually the D1, D2 value will be given in the problem. Natural logarithm problem also will be given in the problem. So you don't have to worry about carrying any log tables with you, nor carrying any normal distribution table with you. So we have value of call and value of put, you don't have to worry. Value of put is using put call parity theorem, you can calculate. If they give you dividend, basics what we discuss in futures. Present value of dividend, subtract from spot price. So if you have any dividend, subtract from S, subtract from spot price, present value of dividend, you will be able to give the impact of dividends. Okay, so this is the summary of Black-Scholes model. Of course, when you do the problem, please revisit theory. It will be more useful. Let me quickly go through the Greeks in option valuation. Greeks in option valuation. We have Greeks, some measure delta, gamma, vega, theta, rho. Okay, let me explain. It is not difficult one. In exam, it's not so important. Theory question is what they can ask. Practically, it's important if you're trading in options. Okay, now I told you factors affecting option premium. What are the factors? Rate of interest, time value, market price, right? When something changes, option premium will change. How much option premium will change is called as Greeks. We have delta. What is delta? We have market price of expiry, market price of underlying asset. Like Reliance options I'm calculating. If Reliance share price changes, option premium will change. Yes, from market price of underlying asset to the option premium. We already calculated delta value formula also. C1 minus C2 by S1 minus S2, right? If the spot price changes by 1 rupee, how much option premium will change by change in value of option premium on account of change in underlying asset? That's called as delta. Now, if volatility changes, if standard deviation changes, if risk changes, if the risk changes by 1 unit, how much option premium will change? That is called as Vega. Time changes as we move one day extra. As the time period changes by 1 unit, by option premium will change. That's called as theta. If rate of interest changes by 1 unit, by how much option premium will change? That's called as rho. If delta itself changes, delta is change in market price. If delta itself changes, then how the market price will change? That's called as gamma. Gamma movement will happen usually towards the expiry. And easy to remember also. V for Vega, V for volatility, T for theta, T for time, R for rho, R for rate of interest. So when one factor changes, by how much option premium will change? We have option premium and we have various factors. So when factors change, by how much option premium change, this connection is given by Greeks. With respect to market price of the underlying asset and option premium, that connection is given by delta. When the delta itself changes with respect to option premium, change in delta, that is gamma. If volatility changes, how market price, how the option premium will change. If the standard deviation changes, risk will change. How the market premium will change, market price of option premium will change. That is Vega. Similarly, theta. Similarly, rho. Okay, so this is the summary of entire option construction, especially from exam point of view, not so from practical point of view. Practically, you have different challenges. And exam point of view, what is a basic problem they'll always ask? Basic assumption, we will have exercise only on expiry. We held till maturity. In option, we always assume that exam point of view we remain held till maturity. But practically, we might do intraday. I might say enter today, exit tomorrow itself. So you will have a different challenges practically. But exam point of view, these are the different terminologies, different concepts, different area of problems that can be asked. Option terms, option holder, option writer, a call option, put option, intrinsic value, payoff, payoff graph, option strategies, put call parity theorem, arbitrage process, option valuation, binomial model, portfolio application approach, risk neutrality approach, two-paired binomial model, Black-Scholes and Greeks. This is the entire gambit of options. Okay, if you have any questions, you can ask. Otherwise, the summary part of options will be completed. When you do problems, come back and recheck these areas. You will be able to connect it better. Okay, I hope you got an idea, overview, summary of the options from exam point of view. Okay, so we were doing discussion on options, derivatives. We discussed about call option, put option. Let us revise with the help of this problem. So by doing this problem, we will be able to get the more clarity. So I'll explain along the course of solving this problem. Come to this problem. Construct the call option holder and call option writer payoff from the information given below. Simple one. Option premium 5 rupees, strike price 100, future price 80 to 100, incremental of 5 rupees each. That is, they're asking under various circumstances. Future price. When I say future price, it means, please understand, it's not the future price what we discussed. I think it's a error in the drafting the question. It meant it is spot price on expiry. This is spot price on expiry. That's what I meant because I prepared this question. I should have been more careful. So when I say future price, don't think about the futures what we discussed earlier. So this is about on the expiry date. When the prices are different number, how your decision will vary, how your payoff will vary. That is our discussion. So spot price on expiry, starting from 80, incremental of 5 rupees each. So explain, if it is 80 rupees, what is your payoff? If it is 85, incremental of 5 rupees, what is your payoff? 90 rupees, what is your payoff? Like that till the end. Okay, let me give you the basics of call option once more. So you'll get the clear picture. Then we prepare the table as required here. What do you mean by options? In options, one person will have the right. Other person will have the obligation. So in this problem, we are thinking from call option holder. So I'll write C plus. Hope you're able to understand call option holder position C plus and C minus call option writer. Now in this case, premium amount is 5 rupees. So this person paid, call option holder paid 5 rupees to the writer, and what he got in return. Can you tell me? I think now you should be able to tell. Holder paid 5 rupees. Absolutely correct. But in return, what he got on the immediate today, immediately, what he got the rights. Now let's be more specific. He got the right to buy the underlying asset at a specific price, at a strike price. At what price now? The strike price is 100. He got the right to buy the underlying asset at rupees 100. At rupees 100. Hope you got the one. He got the right. He can decide. This is today. Now on expiry date, they have not given when is it. Let's say on expiry date. Later, on expiry date. Let us say market price. I'm just taking a symbol. Suppose market price is extreme 80 rupees. Market price of the underlying asset is 80 rupees. Market price of the underlying asset is 80 rupees. And you have got the strike price. You have the right to buy. This is market price if you go to market. And strike price in options is rupees 100. Okay, so if you go to market, you can buy at 80. If you go to strike price, you can buy at 100. Obviously, at what price you would like to buy? Would you like to buy at 80 or would you like to buy at 100? Obviously, you would like to buy at 80. That means you would like to, if you want to buy, you go to market and buy it, not in the options. So here, options, I mean call option here, options will be costlier to buy. So in case of futures, what used to happen? Whether costly or less, no choice. You have to execute. Agreement was there. Loss or incur, profit also incur. But here, holder has a choice. So option will be costlier to buy. Therefore, the holder will not exercise. Option holder will not exercise. And will not exercise means option will lapse. Option lapses. Okay, this is one situation. Suppose I'm taking extreme situation. They said incremental of 5 rupees each. We'll come to that. We'll prepare a table. But we're discussing a concept so that the option also gets revised. That's the idea. Suppose market price of underlying asset is other extreme 120. What will be the strike price? Strike price continues to be 100. That does not change. That is already agreed. We have already agreed. If you are buying, you'll buy at 100. Now, if you go to market, you will buy at 120. If you come to the options, you will have 100. Therefore, it is cheaper in the options. Options will be cheaper to buy. So, it's cheaper to buy in options. Cheaper to buy in options. Cheaper to buy in options. How much cheaper? Cheaper by 20 rupees. That's what is called as intrinsic value. How much cheaper? Cheaper by cheaper by rupees 20. That is what? Market price minus strike price. Cheaper by 20 rupees. Or another way you can also understand. You buy in the options here at 100 rupees and go to market and sell it at 120. You make a profit of 20. So both way you can view. If you're planning to buy and hold, that means you'll have a saving of 20 rupees. If you're planning to buy and sell immediately, then you will have profit of 20 rupees. Either ways, the value of the option, it's worth 20 rupees. That's worth. What does it worth on intrinsic value? In terms of saving or in terms of profit, that is called as intrinsic value. So this also can be settled by delivery basis. If it is settled by delivery basis, what is going to happen? The question of settlement on delivery or net does not arise if option is not exercised. Anyway, you're not going to do, right? If you want to buy, you buy from market. In the option, it's not exercised. But when the option is exercised, you can understand settlement on delivery basis or settlement on net basis, both will be equal. That's what we discuss in futures also. Okay. Here, if you want to settle on delivery basis, how the holder is going to do? What will holder do? The holder will be paying 100 rupees because he has the right to buy, still has to pay 100 rupees. He pay 100 rupees on expiry date and get one share or goods, whatever is the underlying asset. He will receive the underlying asset. That's all, matter over. This is settlement on delivery basis. If you want to understand settlement on net basis, how is going to happen? Only that extra profit what you have, that you will receive. That is, the contract is cancelled, net amount 20 rupee will be received, the intrinsic value will be received. Are you able to understand? Settlement on delivery basis means strike price will be consideration and underlying asset will be transferred. Settlement on net basis means whatever intrinsic value will be the cash flow on expiry. If you want, I'll do a quick chart for you so you remember that. Settlement on expiry. If exercised, if does not exercise, this question does not arise. If exercised, then it can be settled on delivery basis, settled by delivery, or settled by net basis. And for your information, this settlement by delivery basis, settlement by net basis is very important in your FR, financial instruments, to classify whether this as a financial asset or liability or not, financial instrument or not. Derivatives, there's important discussion there in your FR, Ind AS 32-109. If settlement on delivery basis, certain type of condition to be looked at. Certain settlement by net basis, certain condition to be looked at. Please try to connect when you read there. Okay. Settlement by delivery basis means the underlying asset will be transferred, and the strike price will be paid. Settlement net basis means only differential, which means intrinsic value. The underlying asset will not be transferred. And strike price, not strike price, intrinsic value will be settled, will be paid. Intrinsic value will be paid. or received, as the case may be. One person will be pay, other person will be receiving it. Exchange, that's what I meant. Okay, so whatever happens for the call option holder, opposite for writer. Okay, so in this example we're discussing, so 120 rupees minus 100, so intrinsic value was 20 rupees. Sorry, intrinsic value was 20 rupees, but you already paid a premium of 5 rupees at the beginning, at the time of entering into contract. So holder paid a price of 5 rupees. Now he gets a saving benefit of 20 rupees. Net payoff, net profit, payoff, you can say, and that is 15 rupees. Correct? But in my first example, 80 rupees, you did not receive any intrinsic value, but premium whatever you paid is gone. That is 5 rupee premium is your entire loss. So for the holder, the payoff formula, overall profit formula will be intrinsic value minus premium. Intrinsic value is the benefit received on expiry date. Premium is the amount paid at the time of entering into contract. Differential amount will be your net profit, that is payoff. So when does the holder makes profit? When does the writer makes profit? Let us look at this here. So to do these things, let's follow some structured tabular format. So for every problem, we can follow that, which is very, very, very simple tabular format. So let's have the column like this. So 1 second. Okay. Okay, so let's have the column like this. Market price on expiry. That will be variable. Then depending on market price, intrinsic value. Then premium, payoff. For the holder, I'll say C plus, call option holder. Then we can say payoff. For writer, C minus. What is the formula for payoff for C plus holder? It will be intrinsic value minus premium, IV. I'm writing, it's not 4, it's IV. Payoff for writer will be reverse, premium minus intrinsic value. So let's prepare this table in every problem when we are computing the payoff in options. So let's follow the structural format, easy to follow. And when you do it repeatedly, it will come to you automatically. Okay, market price on expiry, what are the values? 80 till 85 and so on till 120. 80, 85, 90, 95, 100, 105, 110, 115, 120. Now intrinsic value will be calculated by how much? Market price minus strike price. For the call option, intrinsic value is market price minus strike price. Now in the first case, market price is 80. Strike price anyway fixed at 100. So can I say 80 minus 100 equal to 0? How much here do you think we are going to write? Do we write 80 minus 100 as minus 20? We don't write. We write 0 because option will not get exercised here. When the market price is less, option will lapse. The holder, knowing it is a loss, he will not do it. He will not incur. Why he will get that benefit? He already paid a premium for it. So he will not incur this loss again. Therefore, we can write, if you write a formula in Excel, we can write like this. It is maximum of market price minus strike price, comma 0. It will not go below 0. So in market price is less, 80, option not exercised, so intrinsic value becomes 0. So 80 minus 100, blindly don't do minus 20 like a Excel or like a math calculator, apply. 85, again option will lapse, 0. You can say here all option will lapse up to 100, because up till then market price is less or equal to, so option lapses. Or till then, till 100 we can say this is out the money. Till 95, let's say 100, out the money. Only after 100 the option gets exercised. Of course, at 100 it's at the money, but beyond 100 it is in the money. At 100 it's at the money. So below 100, above 100. I hope you remember this. So option will lapse. So intrinsic value will be 0. When the market price is less, the call option not beneficial to go to market and buy. It's better to go to market and buy. Option is not beneficial to buy. Call option, think from a holder point of view. Call option meant for a buyer. Call option holder means he want to buy. Put option holder want to sell. So strike price in call option is buy price for the holder. In put option, the strike price is sell price for the holder. We think only from holder point of view, because writer just should oblige. He can't make decisions. So you only think from holder point of view while making calculations. Okay. Now next one, 105. Here 105 minus 100. Market price 105 minus 100. So you get 0. Then 110 minus 100. Sorry, 105 minus 100 means you get 5. 110 minus 100 means you get 10. Then 115 minus 100, you get 15 rupees. So 5 rupees increase, you get 5 rupees more. 120 minus 100, which is 20. Okay. Premium paid is 5 rupees each. It's all about 5 rupees. Everywhere 5 rupees and paid at the beginning itself. Payoff for the holder. Payoff for the holder will be the intrinsic value minus premium. So 0 minus 5. Minus 5. 0 minus 5. Again minus 5. 0 minus 5 minus 5. 0 minus 5 minus 5. 0 minus 5 minus 5. 5 minus 5 0. 10 minus 5 5. 15 minus 5 10. 20 minus 5 15. Okay. Now premium payoff we discussed. Payoff for the writer. Payoff of the writer will be premium minus intrinsic value. So what is premium here? 5. Intrinsic value 0. So 5 minus 0. So plus 5. 5 minus 0 plus 5. Again plus 5. Again plus 5. Again plus 5. And here 5 minus 5, 0. And here 5 minus 10, intrinsic value 5 minus premium 5, and intrinsic value 10, 5 minus 10 minus 5. Then minus 5 minus 15 minus 10, 5 minus 20 minus 15. And please observe here, whatever is the payoff for the holder, let's say minus 5, and here it is plus 5. Exact opposites. Here it is 5 minus 5, and here it is plus 15 minus 15, and so on, and so on. Okay, so with this table now, we can understand few more things. Like what? What is this situation is called as? Where you get zero payoff. Any idea? What do we call normally when you get zero payoff? Zero profit, zero loss. That's called as break-even point. Break-even point, right? Profit equal to zero. So this break-even point, at what is this break-even point? It's not at the money. At 105 we got break-even point. So 105 is called as break-even market price. Break-even market price. Meaning if market price is 105, then only the holder makes profit. I mean zero profit, zero loss. If it goes beyond 105 only, profit is there for the holder. As long as it is below 105, holder overall payoff still makes loss. Okay, now let us look at the formula. Now what is this, or how 105 exactly arrived at? Are you able to think? 100 rupee was the strike price. 100 rupee was the strike price, right? And then we had premium paid 5 rupees. Now as I told you, in call option, strike price, I'm thinking from the holder point of view. In call option, strike price will be buy price or sell price. It was buy price. If you decide to buy price, which is 100 rupees, and premium what you have to pay? 5 rupees. Both are paid. So break-even point means what? Receipt should be equal to payments, inflow should be equal to outflow, sales should be equal to purchases, cost should be equal to sales. So my inflow should be equal to outflow. Then my profit will be zero profit, zero loss. Inflow should be equal to outflow. Now inflow means how much? Here market price is inflow, which is what we need to calculate. We don't know market price. Now outflow means what are the amount you are going to pay. Strike price you are going to pay. Premium you already paid. Effectively both are outflows only if exercised. So effectively the market price equal to strike price plus premium. In this example, strike price 100 plus premium of 5 rupees. You get 105 rupees. So that's what it is. Break-even point. Break-even point. Break-even point. Okay. One more thing, I'll just discuss it here. For the holder, for C plus. Now, can you please tell me what is his maximum profit in this example for the holder? It is 15 rupees. Is this 15 rupees? If market price goes up further, how much will be his profit? Profit will be keep on increasing, right? 15, 20, 25, 20, 30, 35. As the market price goes up, his profit also goes up. So we say profit chances unlimited. Nobody gets unlimited profit, but possibilities are unlimited. So profit is unlimited. Profit is unlimited. Unlimited profit. Now, what about loss for the holder? Market price is down to 80, we got loss of 5. What if market price comes to 75, 70, 65, 60, 55, 40, 30, 20, 10? Whatever may happen, loss is limited to premium. Loss is limited to premium. So for the holder, loss is limited, profit is unlimited. That is, whatever the amount of premium is the maximum loss. You cannot get loss beyond that, because if it is loss beyond that, you don't exercise. You always have the choice. Okay. Now, if I tell you for the writer, what will happen for the writer? See, minus if I say, what is his profit? His profit is limited to premium. Profit is limited to premium. Profit is limited. Whereas loss, it can be minus 5, minus 10, minus 15, any number. So loss is unlimited. Loss is unlimited. So if I look at this theoretically, at this point in time, would you like to become a holder or would you like to become a writer at this point in time? Obviously, you will say holder, which is what absolutely correct, because limited loss, unlimited profit. Whereas with respect to the writer, it is limited profit but unlimited loss. Unlimited loss. So you don't want to become a writer. Different again, only when there is a holder, writer comes. Only when there is a writer, holder comes. So we need both parties in the market. Otherwise, transaction trade cannot happen. Is there a validity period? Yes, definitely. We will discuss, right? Expiry dates. There is definitely expiry dates. Particular expiry date. All this discussion what we're having is market price on expiry date. Right? Definitely expiry date should be there. At the end of the month, what we discussed in futures like that. Here also, expiry date, excess period will definitely be there. Okay. So, I personally usually do most of writings. I mean, writing means I become mostly writer more than holder. Again, different philosophy, different opinion exists. But keep it in mind. You should not only look at the profit or loss, you should also look at the chance of getting it. See, you buy a lottery ticket, you pay 5 rupees, and what is the chances you would like to get? I mean, what is the amount you get if you win the lottery? Let's say 5 rupees, you might get 5 lakh. So does it mean I lose 5 rupees, I get to 5 lakh? My risk reward ratio is very good. I buy lottery ticket. That's what many people think. But 5 rupee you pay less. What is the chance of you winning? That matters. So call option holder, you get profit unlimited. But what is the chance of it? That is interesting. Anyway, I'll come to it once we go further. So what we do, all these things, I will represent it in the form of a graph. So you will be able to understand it better. Let's represent in the form of a chart. Okay, let's understand this same thing in the form of a chart. Okay, this is called as payoff graph. Payoff graph. So on x-axis, I mean y-axis, I'll have the payoff. On x-axis, I will have the market price on expiry. I need positive side, negative side. So both upside, downside, zero payoff here. And market price cannot be negative. So I'm only writing the right side. So starting from 80 till 120. So we have till 80, 85, 90, 95, 100, 105, 110, 115, 120. Okay. For 80 rupees, I mean, what are the payoffs we are having? Minus 5. Okay. We are having incremental of 5 rupees each year. Okay. So we will have like 5, 10, 15, 20. I mean, 20 is sufficient, but still 25. Here also minus 5, minus 10, minus 15, minus 20. Okay, let's do for the holder first. We have got at 80 rupees, your loss is limited, 5 rupees. At 85 also, 5 rupees only. Your loss, minus 5. At 90 also, minus 5. 95 also, minus 5. 100 also, minus 5. 105, your loss becomes 0. So it comes here. 110, your profit is 5 here. At 115, 105. At 110, your profit is 5. We are representing payoff. Okay, payoff, overall profit. At 115, we get 10. Somewhere here. At 120, we get 15. Okay. If we join, it looks like this, a flat line and then upward. So this is the payoff for call option holder, C plus. Call option holder. Similarly, if I do for the writer, when it is 80 rupees, you get plus 5. You get here 85 rupees, you get plus 5. 90 rupees, you get plus 5. 95, you get plus 5. At 100, also you get plus 5. 105, you get 105. And then you get 5 rupees, 5 rupees, 5 rupees. Sorry. I'm sorry. At sorry, I wrote wrongly. At 80 rupees, you get what is the loss? I'm sorry. You have to look at that thing. At 80 rupees, you get profit of 5 rupees. Correct. At this is fine. Profit of 5 rupees. But 105, you get 0. That is also fine. At 110, you get minus 5. 115, you get minus 10, right? And at 115, you get minus 10. At 120, you get minus 15. So minus, the loss will come down. I mean, loss will keep increasing. So this is a flat line. And then join, you get a line. 15. And it keeps coming down. It keeps coming down. So this is the payoff for the writer. For C minus. And what we have for holder C plus, unlimited profit, limited loss. And here for the writer, limited profit, unlimited loss. So here, and this is break-even point. Break-even point, which is 100 strike price plus premium, 105. Strike price plus premium. So when does holder makes profit? Holder makes profit when the market price goes up. When does writer makes profit? When market price comes down. But limited profit. His profit is limited. Limited profit. profit is limited. These are different possibilities. Again, I repeat, these are different possibilities. That can happen on expiry. Whereas futures we have not discussed like this, because futures will be very simple. Market price going up, or market price coming down. So it was very simple upward downward line. There was no flat line coming. As the market price goes up, long position keeps profit. Market price coming down, you keep making losses. So one way up or one way down. The flat line was not there. But here in option, the flat line is the interesting point. The premium is the interesting point because the holder will have a choice. Okay, hope you got the clarity here. Okay, let's go further. Okay. Now we'll do a problem on put options. You get again more clarity. Now purely on put options. Then we'll summarize both also towards the end. Come to this problem. Suresh bought a 3-month put option on Billcare shares on 31st December 2014, which is currently trading at rupees 40 with a strike price of 60 for a premium of rupees 2. Determine whether the option is exercised or not in the following case of spot price after 3 months. That is spot price after on expiry date on 31st March 2015. Okay. Put option. Put option holder P plus. Put option writer P minus. So put option holder pays premium to the writer, pays premium. In this example, pays premium of rupees 2. And what he gets is the right. Now, can you tell me what right he get to be specifically? Right of what in this problem? Right to sell, correct. Right to sell what? Right to sell, in this case, underlying asset is the Billcare share. Right to sell the underlying asset at what price? At the strike price of 60 rupees. At strike price of 60 rupees. And when does he get the right? He will have the right, but when he can exercise? After 3 months on 31st March 2015. So on expiry on 31st March 2015, if the market price happens to be, let's say, 40 rupees. Now, as a put option holder, your intention is to sell. At 40 rupees, would like to sell, or strike price in the market, strike price in the option, it is agreed at 60 rupees. At what price would you like to sell? You go to market and sell it at 40 rupees, or come to the option and sell it at 60 rupees. Option is attractive, right? Option is attractive to sell. Option, because 60 rupees you get, extra paisa you get, 60 rupees. Option is attractive to sell. And how much additional income you get, how much attractiveness is here, the extra income what you receive, benefit what you receive is over and above 40 rupees, you get 20 rupees extra, right? In the options, you get 20 rupees extra. And what do we call that benefit as? That's what is called as intrinsic value. Strike price minus market price, that is 60 rupees minus 40 rupees, 20 rupees. So intrinsic value in call option is like a savings in expenses. But in options, it's like how much extra income you get by being in options. How much extra income you get by being in options. Or you can also understand like this. In the market, I purchase at 40 rupees, and in the options, I sell at 60 rupees. By buying and selling it, profit of 20. Or I can say by selling in the option, I get extra income, extra benefit, incremental income of 20 rupees. That is called as intrinsic value. On the other hand, if market price happens to be, let's say, 70 rupees, strike price is 60 rupees. Now, where is it beneficial? Where is it attractive to sell? Market price is high, right? So market is attractive. Market is attractive to sell. So what will happen to the option then? Option is not attractive. Option will lapse. And option will lapse means intrinsic value becomes 0. Option will lapse, intrinsic value becomes 0. And same thing for the holder. The premium already paid, the 2 rupee will be an expense. And here, premium already paid will be expense. So in the second case, whatever premium paid will be going to be lost. For the writer, the premium received is going to be income, but the intrinsic value what you calculate is going to be your outflow. So for the holder, premium goes in, intrinsic value comes in, if at all. For the writer, intrinsic value goes in, goes out, premium comes in. Or you hope you will understand that inflow outflow mechanism. So when the option exercised, who makes the profit? Tell me this. In general, I'm asking. When the option exercised, call option holder, who makes the profit, or put option holder makes the profit? When the option exercised. In general, I'm asking. When the option is exercised, always the holder makes the profit. Whether call option, put option, secondary. The holder makes the profit when the option exercised. Because he already paid premium, he wants intrinsic value. Because he wants recovery of cost. So premium is like investment. And recovery will happen through intrinsic value. Whereas for the writer, he has already received premium. He don't want intrinsic value. He don't want option to exercise. Because if option exercised, he has to pay out of his pocket intrinsic value. So premium is the expense for the holder, income for the writer. Intrinsic value is the expense for the writer, income for the holder. Just opposite parties, that's all. For one person it's inflow, other person it's outflow. Okay. Fine. So this is the case. We'll prepare a similar table like the call option. In this case also, we'll summarize. After this, we'll summarize call option, put option in a single manner. One more thing. Uh, okay, I think in the table we'll understand what is the unlimited profit, limited profit, break-even point. All those things we'll discuss when we prepare the table. Same table we'll prepare. Market price on expiry, intrinsic value, premium, payoff for holder, C plus, not P plus, payoff for writer, P minus. And what is the formula for payoff for the holder? Always the formula for the holder is intrinsic value minus premium. Whereas for the writer, it's always premium minus intrinsic value. Okay, so now market price on expiry. Okay, starting from 40 going till 70. So 40, 45, 50, 55, 60, 65, 70. Intrinsic value. Intrinsic value formula is strike price minus market price. And you know, it cannot go below 0 for the holder. So, comma 0. Maximum of strike price minus market price, comma 0. So, strike price is 60 rupees. So, 40, 60 minus 40. 60 minus 40, 20. 60 minus 45, 15. And 50 minus 45, 5. 55, 55, 60 minus 50, sorry, 60 minus 50, 10 you get. 60 minus 50, 10. 60 minus 55, you get 5. 60 minus 60, you get 0. 65, 60 minus 65. How much 60 minus 65 comes to? 60 minus 65. We should write 0 only, correct. And 70, 60 minus 70 also will write 0. So up to 60, I can say this is in the money. And this option exercised. And after 60, out the money. And here option lapse. Of course, after, at 60 rupees, we say at the money. Here it is indifferent. Premium. Premium everywhere 2 rupees only. Payoff. For the holder, intrinsic value minus premium. 20 minus 2, 18. 15 minus 2, 13. 10 minus 2, 8. 5 minus 2, 3. 0 minus 2, minus 2. 0 minus 2, minus 2. 0 minus 2, minus 2. Okay. Okay, payoff for premium here. For the writer will be reverse. Premium minus intrinsic value. 2 minus 20 minus 18. 2 minus 15 minus 13. 8 minus 10. 2 minus 10 minus 8. 2 minus 5 minus 3. And this will be plus 2 plus 2 plus. And you can see for whatever the writer and the holder, exact opposite. One person's profit, other person's loss. We'll discuss everything. Break even point, maximum profit, maximum loss, everything we'll discuss. Okay. Hope this table is done. Okay. Let me explain. So on x-axis, we will have market price. On expiry, y-axis, payoff. So what are the things we have got? At 40 rupees for the holder, what we got income? At 40 rupees, we got 18 rupees, right? Premium. Somewhere here. 18 rupees. 80 rupees. At 45 rupees, we got 13 rupees. 45, we got 13. Somewhere here. Little below 15. At 50 rupees, we got 8. At 50 rupees, we got 8. Below 10. At 55 rupees, we got minus 3. Somewhere here. Sorry, plus 3. Sorry, not minus 3, plus 3. Plus 3. We got somewhere here, a little bit below. At 55, we got here, somewhere below. As you can see, as the market price increased, the profit coming down. Then after 60 means you get minus 2. Flat loss. Minus 2. Here minus 2. And here minus 2. And if I join the graph, it looks like this. So I just put it like here. I think it looks like better graph. Yes. This is what is the payoff for the holders. So write the x, y, x separately. This is market price on expiry. This is payoff. And this blue one is the payoff for the holders. Payoff for P plus put option holder. And you can see as the market price increase, the profit comes down. Now, how do we do for the writer? Exact opposite. Simply you can write exact opposite. So here whatever the point was there, minus 18 plus 18 becomes minus 18. And here it was for 45. It was plus 13. And here it becomes minus 13. You can just write the exact opposites. Exact opposite. reverse. This is the payoff or writer. As you can see, when the market price comes down, he makes more profit. Payoff writer, as the market price increases, he makes more profit. Writer. Anyway, so this is for payoff writer. Okay, let's understand about the break even. You write the chart, then we'll write the break even point, and the profit analysis also will do. Okay, hope it is done. Now, let's look at the break-even point. We know this is the break-even point, right? This point, where the zero profit, zero loss is. This is the break-even point. Let's understand how. Now, what is the formula for simple calculation of break-even point? I told you, inflow should be equal to outflow. Now, think from the put option holder point of view, strike price will be inflow or outflow? Strike price for the put option holder. I have an agreement to sell at a certain strike price on the expiry dates. So strike price for the put option holder will be inflow, right? So strike price will be inflow. Strike price will be inflow because that's what my selling price. What about my out premium? For a holder, he always has to pay for the right. So premium will be outflow. Premium will be outflow. And what about market price? Market price is the price at which I'm going to buy and sell in the options. Because in the option, I have to sell. So notionally, I'll buy from the market. I'm comparing the market price. So market price is my buy price. So market price is my outflow. Market price on expiry. So what is going to be market price? If I bring the premium to left side, strike price minus premium. That is my break-even point, market price on expiry date, break-even point. In this example, let's apply. What is the strike price? Strike price was 60 rupees. Premium 2 rupees. So how much you get? 58 rupees. You can see this amount represents the break-even point at 58. This point is exactly 58. Okay, now let's understand about the payoff portion for the holder. You see, payoff for the holder, loss is limited. Limited to premium. How much profit? Profit is almost unlimited. I don't say unlimited, almost unlimited. For all practical purpose, we say unlimited only. Almost unlimited. Why almost unlimited? Because you see this line keeps coming down. There is a stopping point, 0. Market price cannot go below 0. Correct? So we stop at that point. So maximum profit, there is a limitation. You will not have below 0. So all practical purpose, practically it's almost unlimited. Theoretically, we say market price only can become zero. Market price cannot go negative. There is a cutoff point. But practically, how can suddenly market price become zero? So that's very, very rare. Any very bad company also will be trading at some price. So zero is practically will not be there. No company will be trading at zero. At least 0.15, 0.2 will be there. But theoretically exist. Practically not possible. Theoretically, that market price can become zero. So what is the limited profit? Theoretically, market price can become zero. What is your profit? Strike price minus market price. If market price becomes zero, entire strike price minus premium is your profit. I tell once more. What is the intrinsic value for the holder? Strike price minus market price. If you want payoff, minus premium. Now, market price, if it becomes zero, theoretically, not possible we know, but theoretically zero, your profit will be what? Strike price minus premium. So here you can say, theoretically, it is limited profit. Theoretically, limited profit, which is the maximum profit possible. Theoretically, maximum profit equals maximum profit equals the strike price minus premium. Same thing only, this one. Because market price would become zero then. Strike price minus premium. Again, for the holder, for the writer, profit is limited. Loss practically unlimited, almost unlimited. Profit loss theoretically maximum loss is same, strike price minus premium. Okay, hope you got it. Okay, let's go further then. Hope it is done.